All right, so today is Wednesday, August 2nd, week 4. Video is on. Today, we're going to focus mainly on finishing up the valuation of Starbucks and then probably practicing on a second company to set up your next kind of homework assignment. But before we do, questions or comments about anything so far? I mean, I noticed right before class, I looked at the homework assignments for this week, and it looks like everybody was able to basically match the file from last week. So that was really positive. We're going to be starting with that file in just a few minutes. But again, questions about anything? All right, so I know for teams, we had a couple of emails of some teams, and I need really everybody needs to select a company for your team projects. So let's go back here to Chrome and go to our groups for team projects. So everybody should have a team selected. So far I got who wanted Planet Fitness was this group, I believe. So Planet Fitness, I believe is who you chose.
Yep, we did. Thank you.
All right. And then Disney was one of the teams with group 4, I believe. Go ahead and make sure I add that there. And I got one more team. Or did I get any other teams? Maybe I didn't get any other teams. All right. So how about the other groups? Who have you chosen as your company for the analysis?
I think Team 5 are doing Qualcomm.
Yeah, I sent you a note about that.
All right.
This is
Sorry.
Mike.
I'm gonna miss that. Qualcomm. Let's type in here. All right, that leaves team 1 and 3.
Team 3 is doing Home Depot.
Okay. Great. That just leaves you team 1.
Team 1 is still deciding, but we'll have it to you by tonight.
All right. Yeah. If you can just kind of chat amongst yourselves while we're doing something. Obviously, you can't pick one of these companies and anything that we're working on during class.
Okay, great.
So what I'll do now that we have the teams is, again, in this files folder, I will set here the companies that you have chosen, and then I'll start putting from my side the data files that you'll need from my side to basically start doing your work. So again, really right now, we've completed 2 parts of the analysis that you'll need to do. The third part we're working on this week. Basically, you'll need to do an EIC on these companies. You'll need to include the 5 forces. You will need to do the historical analysis of the CFI and the ROIC trees. Now, the model that we've built for Starbucks basically will help you do that, because once you put the data in, it will auto create those for you and then do the analysis off of that. And obviously the valuations, which we're going to be working on. One of your team members' models you'll use for your group for the valuations. So again, I'll give you the raw data that you'll need in folders to be created here. All right. So questions about that? Anything else, as I said, before we turn our attention back to Starbucks? All right, so where we left off during our last class is here in the files, which you'll need, that we did for Starbucks. And we didn't value at the time its stock price. But conceptually, a lot of what we need to do to build their stock price is here. So again, just as a high level reminder, when you build an enterprise DCF cash flow valuation model, the idea is intrinsic value, you're worth the sum of your future cash flows. So we are basically modeling and forecasting the cash flows of a company. And so the idea was that we started with income statements and balance sheets. We then converted historical ratios for the income statement and balance sheet. Everything is a percentage of sales. So we had 5 years of historical ratios. We then created the concept of 5 years plus 1, so 6 total years of forecasted ratios, and the plus 1 year is the continuing value period. So 5 individually forecast years and the continuing value year, which is kind of M. But those 5 plus 1 or 6 years created 6 years of ratios, created 6 years of financial statements, which created 6 years of economic statements, which created 6 years of essentially cash flows, which we turned into this DCF valuation tab. So the idea is if those ratios and statements come true, then these would be the cash flows generated by Starbucks. And based on those cash flows, that will be the stock price. Right now, we kind of cheated last week in that for the future, as we were building the model, we just said, what would happen if the previous year, 2022, repeated itself into the future, right? And clearly, if we get those cash flows that come up with a $58 share price, that's not representative of what Starbucks is actually doing, because in the real world today, Starbucks stock price closed at 102. Okay, so our goal as a next step, which you will again be following me, is to basically try and model out in our valuation model the $102.13 stock price. Okay, and this is going to be a process in this class which we call an as-is valuation, meaning we're going to value the company as is, right? And as we go through this, we're going to do 4 valuations, 4 models. Okay, the first is the as is, and the second we're going to do a target. Like as is just that, it's the current share price, right? What cash flows support the current share price? That's what we're about to do. And then we'll have an Excel model that kind of models out the current share price. Second, we're going to have a target, meaning in the next 12 months, what do we think long term and basically what they'll trade at the next year that Starbucks is going to do based on our opinion. Okay, so basically we'll model out those cash flows and come up with a target share price. And the difference between the current and the target creates a buy sell hold opinion, by the way. And then the final part is that we're going to start looking at range, right? Because think about a portfolio manager, right? If you took any class on portfolio theory, you know that when you look at risk of a portfolio for diversification, you're going to look at standard deviation. I need to know the volatility of my portfolio to optimize my portfolio. So translation, in the real world, funds don't just want to know the price of the stock. They kind of want to know the volatility of the stock. And what that translates to from a sell side analyst standpoint is they want to know upside downside. Okay, so I don't want to just know that Starbucks is going to trade at 120 in the future. That's where I think they're worth. I want to know that they could go as high as 150 and as low as 85. Okay, like that's my range for Starbucks, right? And so those are going to be called the bulls and the bears, right? So we're going to create 4 files, 4 scenarios for every valuation that we do. Okay, so one scenario is the current stock price. We'll model the current stock price, get a baseline. Second, we're going to create a bull and a bear, which is basically a high end of a range of what a company could be and a low end of the range, what they could be, with assumptions that are very clear about what leads to the high end, what leads to the low end. And then we're going to create a target. Where in that range do we think that they're going to end up? And then based on that target share price, we'll compare it to the current share price, and that will lead to a buy sell hold opinion. Right. And that's kind of how sausage is made in the real world. But nonetheless, that's kind of where we're going tonight with our modeling for Starbucks. Yeah, Mike.
So where in all of that, if anywhere, do you think fits for the emotional component of investors? I guess Greenspan called it years ago irrational exuberance. I mean, maybe what you're talking, I mean, maybe the answer is in the long run, all that stuff just plays out and becomes irrelevant. But do we account for the emotional component, or do we not account for it? What are your thoughts on that?
Well, I mean, and you'll see it as we kind of go through the next steps of our model. Every one of these numbers in the future is future, and these future assumptions are just that, they're assumptions. And so, it's hard to be completely Spock about our future assumptions because, even today, people are probably having generally, look what's been having the stock price in the last of companies in general in the last 60 days, kind of a more optimistic view of the future than they probably did 4 or 5 months ago. And so that is going to jade our view of what is good, not only for the total market, but for any company. But that's also why I think it's important to do what I call the bull and the bear scenario. Meaning, even if we're optimistic about a company, we still need to be realistic to say that, what if our assumptions are wrong? What if the assumptions go more negative for a company? What could happen? And we can assign probabilities to either side of the scenario, but that's the point of doing ranges, not just targets. But that being said, I mean, even long term, I mean, there is a market bias that the market goes up 6 to 8% a year over a long period of time. Talking about big company stocks. And so there's kind of an optimism bias when we think about the market for any company, and that's how it'll play out. So we're going to be sensitive to those. So it's not a good answer, but it's reality.
Thanks.
Other questions or comments before we jump into the technical side here? All right. So as I said, you need to pull out your spreadsheets from last week. We're going to pick up right where we left off. And we're going to create what we're going to call the as is model. Matter of fact, I've renamed my Excel file from last week the as is from the start file. So that's file number 1. And we're going to create 4 more Excel files today. But the as is will be the completed valuation file that we need to do. So again, where we're going with the as is Starbucks closed today at 102.13. So the question then becomes, how do we value the company at 102.13 in our actual Excel model? So we need to match that. Okay. So what cash flows lead to that? Okay. So we're going to do a few things. Okay. So first, stay here in Bloomberg. To get to that $58 share price that we have in our model today, if you go to the assumptions tab, cell B4 in assumptions is the WACC. Okay. And when we were building our model, we just had a placeholder WACC at the time of 8%. Right. So what is going to be important as we go forward for any company is we need a current weighted average cost of capital, okay, to discount the cash flows. And so as of today, Starbucks WACC, you can see it right here, estimated by Bloomberg, is 8.7%. Okay, so first thing we're going to do in our model is we're going to change cell B4 to 8.7%. Okay. And just so you can see where this data is coming from, I am going to take a screenshot of this, which I'm going to call SBUCS, ticker symbol WACC, which I'm going to upload to Elms so you can kind of see the roadmap of what we're changing and where the data came from, so that when we do another company, I'll put similar screenshots of other companies so that you can actually know this is the data that you can use to do. But the idea here is we need to have a current cost of capital for a company. And today Starbucks WACC is estimated at 8.7%. And the way Bloomberg is doing it is they're basically doing a weighted average of the debt and equity. They're using the after-tax cost of debt based on the yield to maturity of their bonds. And here they're using CAPM to basically estimate a cost of equity. Okay. So there's the 10-year yield of the treasury. There's the equity market risk premium on the US market, 5.9%. And there is Starbucks beta right now, 0.94. So essentially that is their estimate. So that's what we're going to use. That's pretty market based. All right. So back to our model, that's 8.7. So back to Excel. Change this. My Zoom menu. One second. Lost my Zoom menu to stop the sharing. All right, I'm going to just try and because I'm going to be jumping back and forth, share my desktop right now rather than sharing a screen. So 8.7, I'm going to go back to the model. In assumptions, before that's the assumed WACC that we're using to discount in our model. We're going to now change that to 8.7. By the way, if we do that, notice that the share price in our model goes down to 47. Right? Because if you're discounting at a higher rate, cash flows are worth less. Questions about what we just did? You should be doing that too. All right, so continuing on, what else do we need to do? Well, if you think about it, the operating value is the most important value, right? Meaning, back to Modigliani Miller, operating plus non-operating equals enterprise value. And what's true for most companies is the vast majority of the value for any company is the operating value. So we want to get the operating value right? And so there's two parts of it. First 5 years in our model, and then perpetuity, continuing value. Obviously, continuing value perpetuity is where the vast majority of most companies' operating value will be. So we're going to have to get that right as well. But nonetheless, we want to get the first 5 years to be as realistic as possible for any company, right? Now, all of this operating value is based on free cash flow, right? And so back to free cash flow is right here off of our CFI. It's gross cash flow minus gross investment. It's primarily what's driving free cash flow, which is driving the operating value of a firm. So continuing on, we got to get our free cash flow right. All right, that's going to be the most important part of the forecast valuation for any company. So to make sure we're getting it right, I want to go back to our ratios. Now, I had highlighted in light gray these 3 rows of the ratios. That was just in the file I gave you. I didn't say anything about it last week, but I'm going to come back to why these 3 rows are highlighted in gray. This is the 80-20 rule, or I'd even call it 90-10 rule of driving gross cash flow. Okay, so if we're going to forecast gross cash flow, what's most important? Revenue, EBITDA, and taxes. Okay, because those 3 numbers are pretty much going to be a proxy, if we forecast them right, for gross cash flow. Right? So that's the point, because the whole point is what's gross cash flow? It's our NOPAT plus depreciation. All right. So revenue, EBITDA, tax rate, it's pretty close to NOPAT plus depreciation. So those are the most important things. We're going to forecast EBITDA proxy for our NOPAT after tax rate, and how big it's going to be, the revenue growth rate. That's going to help us drive gross cash flow. So those are the 3 most important numbers to get right for gross cash flow. in the future. The other part is we need gross investment, right? Here is where what we set up last week helps us. Every one of these balance sheet ratios is really operating. Okay, so the reason why I chose to do these ratios as a percentage of revenue is this is pretty much what's typical operating capital for most firms, right? And all of these are percentages of sales. So the whole idea is, since these are percentages of sales, and if we forecast them as a percentage of sales, then as revenue grows, these assets grow. Those are all percentage of sales in the future. That's how we're creating our balance sheets. So that's the point. When the balance sheet grows, the difference between two balance sheets is gross investment. So what we've kind of set up here is that the model will auto create a forecast for you of gross investment, right? Assuming that these balance sheet ratios are staying unchanged, right? And that is typical for most firms, meaning most firms don't really change their productivity over time, okay? If the productivity changes, then we need to change the balance sheet ratios. But the productivity doesn't really change. We don't really need to change the balance sheet ratios. And then as the business grows, productivity stays the same. This model will auto create your gross investment. So that's why I go back to the most important thing, the way this model is set up, the forecast to get right are the three items in gray, because the balance sheet kind of takes care of itself and the cash flows will be created based on these ratios. That's where we're kind of going with the next step of our model. But I want to pause to see if that makes sense or if there's any questions about that. All right. So if we're leaving Starbucks balance sheet alone, because we're going to assume productivity, then we need to get these three numbers right. So the first one we need to get right is Starbucks tax rate for the future. Right. So we are not the only people trying to do this. Right. Wall Street's trying to figure out what a company's tax rate is going to be as well if I'm trying to follow a company. So there are a couple of different ways that we can get a forecasted tax rate for a company. The first is sometimes a company will give what's called guidance. And they can't be too specific with a number. So they usually give ranges or estimates, because if you give an actual number and you miss it, you're going to get sued by some lawyer out there. But the point is that companies will give guidance. And so the question is, did Starbucks give any tax rate guidance? And the last time they gave tax rate guidance was last year. And they said our tax rate going forward is going to be somewhere around 24.5%. Okay. So we could take the company at their word if they haven't changed their guidance to say that that's probably, they said somewhere between 24 and 25. You see that text box, about 24.5 is where they think that their tax rate is going to be on a go forward basis. So we could put that in our model. That's one way to kind of start this process. Right. If for some reason the company doesn't have guidance, what I would also suggest is the analysts on Wall Street are trying to do the same thing we are. They're trying to figure out a tax rate. And so I would say, see what an analyst says. And we have access to the University of Maryland to JP Morgan and JP Morgan Chase, their analyst research, because otherwise you're going to pay for this research, right? But JP Morgan has coverage of Starbucks. So we also have access to a Barclays report. This is a more recent one, May 8th from JP Morgan. And if you actually were to read an analyst report, you will see that one of the things they do, besides give a summary, what they think is going to happen with the company. In terms of their performance, but right, where it is. Quick search here. They're also forecasting tax rate just like we are. And so right now, JP Morgan's forecasting a tax rate 24.5 is the number they're using for this year, 25 for next year. Right, so in a way, the analysts are taking what the company is saying, and that's what they're actually using in their own lives. Right, so that's what we would do. So 2 points. One, the company gives guidance, we probably use that. Analysts are doing the same thing. Two, if we don't have a tax rate guidance, we'd have to try and figure out what it is. And one way to do it, see what the analysts are using, see what the others are using, right? And that will give us a starting point. If we don't have any of that, now we could make some assumptions based on historical tax rates, but we still need to get a realistic tax rate for what the company's going to pay in the future. So right now, 24.5, 25% is in the range of the guidance. So what we're going to do is, for our purposes, I'm going to say 24 point. Now, when we do that, you will notice that our share price went down even further to $45 a share. You pay higher taxes, you generate less free cash. But that's going to be a key assumption that we're going to use. All right, questions about that assumptions, where it came from, why we did it, what we're changing. If you change cell H10 because the forecast year is equal to previous year, they're all adjusted. So 24.5 going into the future. David?
Yeah, so I think you showed us that the JP Morgan analyst also projected 25% for the year after. Should we use that or just the 24.5?
I'm going to stick with the middle of the company's range, the 24.5. But that's actually how you can, get some differences in Wall Street, because you could do that. You could put in 24.5 and 25 starting in the year 24. I can't say you were wrong, and others are doing it. I'm just going to use 24.5 for simplicity for our class, for our purposes. But if you were doing this for an assignment, nothing wrong with putting in 24.5 and then 25 starting in 2024, or you might put in 24 because that was the bottom of the range that they had given. Can't say any of us would be wrong at that point. Chris?
Yeah, Professor, just going back to where you started with those three gray, the revenue growth rate, EBITDA, and tax rate. Is that sort of a necessary simplification for where we are at versus, by the end of this class, or, in practice, we are going to look more, granularly at each of the variables, whether it's balance sheet or income statement?
Well, I guess what I would say is two things. We could change any one of these ratios in yellow, right? And nothing wrong with that. Let's try and be as refined as possible in every forecast we make. But what I'm telling you, that's what I said, 80%, 90% of the impact of what's going to be most important is really these three things. And so if you get those three things right, the rest of it is like window dressing. It doesn't matter that much, right? And that's for most companies. There's always exceptions, but for most companies, because as I said, these three things drive gross cash flow, and getting gross cash flow right, operating value right, is the most important thing when we do a forecast valuation. Now we get a little more granular, but those are the things that are going to have the biggest impact on gross cash flow. And as I said, we want to get gross investment right and free cash flow. But typically, if the productivity stays about the same, meaning the level of inventory they keep stays about the same, the level of receivable days that it takes to get paid stays about the same, the amount of money they spend on stores stays about the same, then the model can auto forecast gross investment.
Okay. I guess like the concern is like we're so dependent on that, getting that revenue growth number right.
Oh yeah. Welcome
that
to
yeah.
Exactly. We want to be as accurate as possible. That's actually one of the reasons why, you start out with an EIC, meaning, all right, I need to know how fast the market for a company is growing. What's the size of the pie? I need to know what their share of the pie is going to be. And then I need to know some details about the company itself and what they're trying to do with their products. So one of the reasons why we do that detailed analysis up front is because when we're forecasting growth rates, for example, or we're forecasting prices, which is going to drive margins and EBITDA, we need to have a better sense of the dynamics of the company and the markets and what they're selling. So yes, but I'm going to shortcut a little bit of that tonight, and that's where we're going to go next. So yeah, let's talk about how do we get better growth in EBITDA. For purposes of this class, we're not the only people trying to do this. So again, I'm going to go back to Bloomberg. If you remember what I told you last week, these analysts, of which for Starbucks, there are 38 of them. They're trying to do the exact same thing we are. They have very similar Excel files, actually probably more detailed Excel files, but doing similar process that we are trying to do, right? And one of the nicest features about a data service like Bloomberg is it's aggregating all of their guesses. All of the model guesses are summarized on this screen. And this is the next 4 to 5 years. This is last year. And these are the next 4 forecast years. And if I were to go over a column, the 5th year through 2027. So with this forecast, what are the analysts forecasting? They're forecasting revenue. And the analysts are forecasting EBITDA. So that's what we're trying to do. But what this screen actually has is what's called the consensus, meaning the 38 people are uploading their guesses. Wisdom in the crowd, the data service Bloomberg is averaging the 38 guesses, and it's coming up with what's called the consensus estimate. So this is the baseline of all of the guesses for revenue for Starbucks for the next 5 years of the Wall Street professionals. I don't think anyone in this class is going to do better than this. I'm not saying we can't get luckier than this, but they probably spend a lot more time and have a lot more insight into what's happening with Starbucks doing the process that we just talked about. So when we do the as-is valuation, meaning I want to value Starbucks to 102, I think the baseline that Wall Street uses is a pretty good starting point to model out what I think the cash flows are going to be. So translation, we want to take the revenue for the baseline for Starbucks analysts today and the EBITDA for Starbucks today. We want to put that in our model as a starting point. Okay. So again, I'm going to take this as a screenshot. Can't get that 5th year. Take this as a screen, 2 screenshots. I'm going to call this Starbucks, and it's called the EEO. Is the actual screen in Bloomberg. And I'm going to take 2 of them because I'm going to take a second one that includes 2027. So we have 5 years instead of 4. Two. We'll load that so you can see what we're about to do.
How often are these estimates updated, Professor?
Whenever the analyst feels like they want to make a change to their model. So typically, and you can see this here. Typically it's done around quarterly earnings because obviously every 3 months, when you can see all these analysts have updated their data as of August 2nd, right? Because basically Starbucks just released their earnings. And when they did their earnings release for the quarter, what'll happen, you kind of see it here, is I'll switch this to a quarterly view. We're dealing with annual data here. But when they release their June 30th, 2023, sorry, sticky mouse. When they release their June 23 quarter actual versus the estimates, like this is what all the analysts were forecasting for the quarter, and this is what they released last week. Okay, so this is the earnings call. So when they do the earnings call, the analysts will have these 2 columns right next to each other, and then they'll have their Excel models open. And basically that's what the Q&A about. They're going to be like, all right, why did you have a lot more net debt than we thought you were going to have? And that'll be one of the questions you're probably going to see on the call, right? Why did the gross margin come in higher than what we forecast? Because what they're going to do is they're going to then say, okay, based on these questions, they have the spreadsheets open and they're making adjustments to their models of the future, right? And so then they'll update their cash flows and then update their forecasts. Because basically, as soon as this earnings call is over with the analysts looking at these numbers and they're adjusting their forecast, the analysts then talk to the buy-siders, the people that are paying them, that own Starbucks stock, to say, all right, what are you coming up with based on this? And then there's a second call that Starbucks senior management will have with their owners, the buy-siders, later in the day. So on earnings call day, most companies will have 2 calls. They'll have one call with the sell-side analysts, and they'll have another call with just the owners, the actual big institutions that own their stock. Okay, but both of them, both the owners as well as the sell-siders, are trying to figure out a forecast for what's going to happen with the company. So back to, when do they update this forecast? Anytime new information comes out, they can update the forecast. But practically, they're going to do it at least once a quarter. And then if there's new big information that comes out relating to a company or an industry or a shock or an M&A or something like that, then they'll also update it when they come in, right? But realistically, they're not doing it daily, but they are doing it with new information. That makes sense. But nonetheless, you can see, they all updated in the last few days. Actually, what is today? August 2nd? They all updated it. Today. Starbucks just released their earnings. All right, any other questions before we go back to that next step? All right. So based on their updates, this is pretty fresh information. Right? What we're going to do is we're going to now put in these numbers for revenue and these numbers for EBITDA into our model. Now, in order to do that, I'll go back to our model. You will notice that we can't directly put revenue and EBITDA in because those are not yellow cells. And I said, I don't want to overwrite and break a formula. Those are formulas. Where are these revenues coming from? These revenues are coming from the percentage change in sales. Where's this EBITDA coming from? It's coming from the margin EBITDA as a percentage of sales. So what are we going to do? Right. Well, we're going to go to our assumptions tab, and starting in previous year +1, so 2023, so cell B10 of assumptions, and going over +1, 1, 2, 3, 4, 5 years. +1. Previous year +1. Any trouble with that? Copy that to the year 2027, just 5 relative years. What I need is I need a estimate of revenue. And I need an estimate of EBITDA. Because if I have those two numbers, what I get is an EBITDA margin. So here, I'm going to have 10 yellow cells going from B11 all the way down to F12. And where my data is going to come from is this screen. Come side by side. So, for example, I'm going to put in, oh, no, don't want to log off. I'm going to put in revenue for the next 5 years for Starbucks. So in 2023, expected revenue, 35,890,000,000. So right here, 35,890. In 2024, expected revenue consensus estimate today, 39,981. 39,981. 2025, the consensus revenue estimate is 44,144. In 2026, it's 47,464. And in the year 2027. Revenue forecast is 51,098. 51 billion and 98 million. That's the next 5 years worth of revenue forecast for Starbucks. So I've just transposed them from what the analysts are forecasting to our model. I'm gonna do the same thing with EBITDA. So 8,129,000,000 is the EBITDA here. Followed by 91,64. Followed by 10,334. 11,681. And in 2027, actually that was 2027. That was 11,681. I forgot I had moved the column over. So that is 2026. So basically these three. Put in the wrong years. And 2023. Back to 2023. Is EBITDA 7,085. So once I put them in the right years, I basically just transposed revenue and EBITDA for Starbucks for the next 5 years. So that it's hidden in plain sight. If I take my EBITDA, I divide it by revenue, that is the EBITDA margin that the analysts are forecasting through 2027. Based on the consensus estimates. 19.7% EBITDA margin this year, expanding to 22.9% EBITDA margin by 2027. Sorry for the confusion about putting the numbers in the wrong row or cells, but did everybody kind of conceptually see what we just did? So that's the idea. As a baseline for any valuation of a public company, we're going to start with the as is, and we're going to use the consensus EBITDA margin for the company in the as is, based on what the analysts are currently forecasting. So we're going to use revenue and EBITDA, because unfortunately, for whatever reason, the data service doesn't give us the margin as a percentage, even though those two numbers give you a margin as a forecast. But these are the next 5 years of EBITDA. So that when I go to my ratios, these numbers for the next 5 years need to basically be those numbers. So what I'm going to do in my ratios is starting with H7 of the ratios tab equals, from my assumptions, B13, and copy that all the way over to L7. And for my purpose, I'm going to make those cells no longer yellow, because these are now coming from the consensus. These are not coming from numbers that I'm inputting. When we do that, you will notice that the share price changed to 65. All right, questions about what we just did? Able to copy that, follow that, these numbers on the screen?
Quick question, Professor. So the forecast, I thought we went through 2028. Do you just have the 2028 figure just referencing the 2027?
We're going to come back to 2028 in a minute. because 2028 is our continuing value perpetuity year. And we'll talk more about that in a minute. These are just the next 5 years, year by year forecasts. That's why I stopped at 2027.
When I do this copy, I get this error message spill. I'm not doing it right. Is there a trick?
Just
Copy multiple cells at once?
Yeah, I would just select B13, Control C or Command C, depending on PC or Mac. Select them all.
Yeah.
Command V or Command C or Command.
Oh, I see. Yeah. Okay.
Control
You
V.
don't do an equal copy over. I got it.
Yeah, it makes it easier.
Thanks.
Any other questions? We're gonna follow that. Now we have two choices on what we can do with the revenue growth rates. Because we can't put the dollars of revenue in, but what we have to do is we have to get the revenue growth rate that leads to those dollars. So then the question is, how do we get these revenue growth rates? Option one is, believe it or not, there's another screen on Bloomberg, which actually gives you the revenue growth rates. It takes those numbers and turns them into percentages. Right? Option two, which is what we're going to do, since I already took the time to type them in, rather than typing in the percentages again, I know what these percentages are because there's a percentage change formula. So I'm just going to use the formula. So back to 2023 revenue growth rate equals the formula for percentage change is current year minus previous year divided by last year. So for 2023, current year equals assumptions B11 minus previous year's revenue, income G3, 2022 actual revenue, right parentheses, divided by last year's revenue, income G3. That's 11.3%. So basically, if we grow 11.3%, revenue grows to 35.8. Right? So I'm gonna do that again. Next all over equals current year. So for 2024, I3, go to assumptions. It's 2024 revenue, C11 minus previous year's revenue, B11 divided by B11. That's going to grow 11.4%. And now that I'm all in that page, copy, paste over 3 more. Those are the next growth rates. So that by 2027, that will lead to revenue of 51,098, which matches the 51,098. So I'm just solving for the revenue growth rates based on the actual revenue. But these are for the next 5 years. And again, I'm going to make those on yellow. Those are the actual analysts' revenue growth rates for Starbucks today. So given those growth rates and those margins, we get to that share price. Now we still need to get to 102. Got a ways to go. But right now we're at 59. But as I said, we got the key drivers of gross cash flow in here. We got the right growth rate. We got the right EBITDA. We got the right tax rate. Again, questions about anything I just did? How to do it? Joseph,
Can I see that formula one more time?
which one? The revenue growth?
Yeah.
So it depends. It's the formula is just current year minus previous year divided by previous year. That's just the formula for percentage change. And so for H3 here, I did the revenue from assumptions, B11, minus the 2022 revenue, which was off the income tab, divided by the 2023 revenue off the income tab. For 2024, it was all off the assumptions tab. 2024 revenue minus 2023 revenue divided by 2023 revenue. That's the formula that's in this cell. And then once I have current year minus previous year divided by previous year on the same tab, I just copied it over. That was I3. Option 2, if you didn't want to put percentage change, as I said, I could have given you this screenshot. And then you could have just typed in these numbers. I just didn't want to type them in again.
What valuation are you at right now, or share price value?
The one I'm getting right now is 59.04.
Okay, thank you.
As a matter of fact, it's gonna get annoying every time we change a number to go click on that tab to see what happens. So what we are going to do as a little bit of a shortcut is I'm going to suggest that on the ratios tab down here, we're going to put in cell F1 a model share price. And then what I'm going to do for cell G26 is say equals from the DCF tab D30. That way, anytime I change something in the ratios tab, the share price is visible to see what it changed to. So I have to keep jumping to the DCF tab. I'm going to refer to that. So we're at 59.04. Which leads to another point. What are we trying to do? We're trying to match the current share price. So on the assumptions tab, under shares outstanding, I'm going to add another row, that's why I left a space there, called the current share price. And I'm going to make that a yellow cell. And I'm going to actually put in the current share price of Starbucks, which today is 600, and today they closed at 102.13. So 102.13. And so therefore, on my ratios tab, I'm going to put in equals from the assumptions, the current share price. And I'll put it right next to each other. So that way, I know what my model is and I know what my current is. So if I want these two to be exact, I don't have to keep jumping around or trying to remember what it was.
Professor, could you go back to the assumptions tab for a second? I just wanted to copy a number down. My Excel crashed. Scroll to the right a little bit.
Bigger for you.
Okay,
And
great.
so the other key number here was this one, the shares outstanding, which we got from last week. And you gotta make sure the right share count for a company, because again, if we do another company, it's gonna have a different share count. Right, so this is the other one that we gotta make sure we got in. Starbucks is 1146.4. Where I got that, I'll take another screenshot of this, is under what's called the security description screen in Bloomberg. It's kind of like a summary of a company, but on this screen, right down here, bigger, is the current shares outstanding of a company. It's right there, 1145.4. And that's actually changed. So I need to change that. 1145.4. Because they just released earnings today, I've been buying back some of their stock. So the share count went down a little. 1145.4. That is the current share count as of today. So I got to change that here, which is also going to juice up the share price a little. Now we're going to be at 59.09. There's the impact of buying back stock. Few shares, higher share price. All right. By the way, just so you have this in Bloomberg, I am going to take a screenshot of this. And I'm going to call this SBooks. DES. So 3 screenshots that you're going to get for any company. And this is going to help you. One is this screen, because this will give you the share count. Right. 2, I'm going to give you the WACC. Because for any other company, we'll have to update their WACC. There's the current WACC. And 3, when we do the as is, I'm going to give you 2 screenshots of the forecasted earnings estimates So you have the next 4 years and then year 5, because it only displays for some reason 4 years on the screen. There's revenue and EBITDA, which we're using in our baseline. Everybody with me so far? Okay. 2 more things to go. First, we need, because I've done the first 5 years. Now we need to talk about the perpetuity. This is a very important year, the perpetuity period, because basically, from a perpetuity standpoint, that's going to be most of the value of the firm, right? It's not, you can see in the DCF valuation, it's not the first 5 years, year by year. It's this value, the continuing value, that perpetuity value, that's going to have the biggest driver of a company's stock price. So I want to be somewhat realistic on that. So I need a tax rate in a perpetuity. I think that, right, nothing's going to change dramatically in perpetuity over the next 5 years. I'm going to keep that alone. That's probably okay. I need an EBITDA margin into perpetuity. That could change. And I need a revenue growth rate into perpetuity. Those are my perpetuity values that I really care about. So let's talk about EBITDA margin. What do I think my EBITDA margin is going to be in perpetuity? Right. So here I'm going to cheat. And I'm going to cheat because this is going to be covered in next week's readings, if you haven't done it yet, and in next week's class when we do multiples. But the preview I'm going to give you is that hidden in a multiple is a perpetuity margin for any company, because multiples are just rearranged math of the key value driver equation. And if we know the key value driver equation and you see the trading multiples in the real world, you can work backwards to figure out an operating margin, because basically it leads to an operating margin. And so a preview of next week is, and this is what we're going to put on our assumptions tab, there's 2 numbers that matter, 2 multiples that matter for your operating margin. One is called the enterprise value to revenue multiple, or enterprise value to sales multiple. Those are interchangeable terms. And the other multiple is called the enterprise value to EBIT multiple. Okay, not EBITDA, right? But if you take the enterprise value to revenue and you divide by the enterprise value to EBIT multiples, that will get you the EBIT margin in perpetuity of a company. Right? Now, again, going back to the screen, I'm going to take this as a third screenshot if I didn't do it already, because I don't know if in the last screenshot whether the bottom half of the screen was showing up or not. Let's let me look here. It was not. So I'm going to take this as save ES bucks EEO3. All right, down here are the trading multiples of Starbucks based on future numbers, right? Because here's the point. Companies are going to be more valued based on their future cash flows than historical cash flows. That's going to be more predictive of a company's value. Well, the same is true of multiples. Forward multiples are a better predictor of a company's stock price than historical multiples. And what you're going to learn is that the second forward year going forward multiples are more important because they're more normalized because of the clean 12-month forecast year. Okay. So the problem for Starbucks this current year, which runs through September for them, is we now have 9 months of actual data and 3 months worth of forecast data in this forecast year. I call it a dirty year because it includes actual and forecast data. So multiples tend to get more normalized when you have complete 12 months worth of forecast data. So the analysts are going to key more in on multiples based on this column 2024, then this column 2023. This is called forward year 1. This is called forward year 2. The forward year 2 and 3 multiples are more important than the forward year 1 because these are based on clean forecasts. So how does a forward year multiple come into play? This is a forecast today for earnings per share for Starbucks, right there, year by year. Second forward year is $4.09. So the PE in 2024 for Starbucks is that stock price 102.13 divided by the $4.09 of EPS, which gets you a PE of 24.98. That's called a forward PE. Okay, current price divided by future earnings is your forward price to earnings multiple. Current enterprise value divided by 2024 revenue is your enterprise value to revenue multiple, 3.45. Current enterprise value divided by EBIT in 2024 is your enterprise value to EBIT multiple or EBITDA multiple. Okay, so forward multiples are basically the current value divided by the future earnings. Okay, so what I'm going to care about are years 2 and 3. So 3.45 in 2024 and 3.12 in 2025. That means based on these future revenue forecasts, Starbucks is worth 3.45 times revenue in 2024 and 3.12 times revenue based on 2025's revenue. That's our enterprise value to revenue multiple today. Same thing with enterprise value to EBIT. Enterprise value to EBIT, they are trading at 20.79 times 2024 EBIT today. 20.79. And they're trading at 18.32. Sorry, 18.32 times 2025 EBIT. So what the book tells me, based on the academic math, is that if I take EV to revenue and I divide by EV to EBIT, that would give me the EBIT margin that had to be used to make those ratios come true. So that 16.6 and 17% respectively is somewhere in that range, is the perpetuity EBIT margin that Wall Street is using for Starbucks based on their current share price today. So if we were to go to those analyst forecasts and look up their EBIT margin forecast in the perpetuity, it's going to be somewhere around those numbers because that's what the trading multiples suggest. So here's the point. What do these numbers, are they reflective of? The 16.6 to 17%. What number is that in our model? This is EBIT margin. Right here. And this is 2027. So that number, which is M9, which is not yellow, off the ratios. What the trading multiples tell us should not be 18.1, should be somewhere between 16.6 and 17. That's what the share price of Starbucks tells us today. Somebody had their hand raised up. Who had the hand? Sorry, I had a second ago.
Oh, Professor, I had my hand raised because you asked the question. I was going to try to answer it.
Okay. But so let me ask to answer this one. How do we then change that number to 16.6 to 17? I can't change 18.1. I need to get that to be somewhere around 17. How do I change that? How do I get M9 to be 17?
You refer to your input that you just put in on the assumptions tab?
I don't want to change M9 because it's a white cell.
You have to change
Change-
M7, I think.
I either have to change M7 or M8. Now, M8 is depreciation, and usually depreciation, which is non-cash item, is not going to affect EBIT cash flows. And depreciation doesn't usually change too much as a percentage of sales. So I probably want to change my EBITDA margin. So my EBITDA margin is not going to be 22.9. It's probably going to be 21.8 or 21.7 rounding. So that is going to get me the 17% EBIT margin in perpetuity, because this is my perpetuity margin. So what it really says is, you know how the analysts are expecting by 2027 Starbucks to improve their EBITDA margin to almost 23%? They don't think they're going to sustain that forever. They think it's going to come down a little in perpetuity. And right now, the number in perpetuity is closer to 21.7. Or potentially as low as 21.3. There's a range. Questions about that? Make sense? Chris?
Where did 21.7 come from again?
So what we did is I lowered this number from 22.9, which is where it started. I'll do this. Because I want this number, which was 18.1, to be somewhere between 16.6 and 17. Judgment call in that range, but somewhere in that range is the perpetuity margin that the ratios are suggesting, that the trading ratios today of Starbucks are suggesting that EBIT margin has to be. So therefore, I'm going to change the EBITDA to get that number down in the 16.6 to 17 range. I'm going to say 17. So again, 21.8 because of rounding, 21.7. That's what we just did.
Okay, so you're back, whatever the number is to back into 17.
Exactly.
But
I
you're-
need to change the EBITDA to get to back into in that range, 16.6 to 17. And I'm going to leave it at 17 because the share price is 102. And I can't, like, if I made it 16.6, it's going to go lower than 54. And I'm trying to get it higher to 102. So I'm still going to give them credit for being the top end of the range. We still got a ways to go for their share price. Chris?
Yeah, so basically what we're saying is that those the enterprise value divided by revenue and or basically your EBIT margin, that's what we care more about rather than sort of the trend that we're building up from 2023 to 2027. I was thinking like the other approaches that you take an average, you know,
This.
2023 through 2027.
Yeah, because D9 is much more important than D2, D3, D4, D5, or D6. This
But I
is
mean, to get the value,
This is separate.
value for my continuing value. So for my sorry, I'm talking about the EBIT margin. Would I prefer to go about it this way rather than taking an average of my EBIT margin 23 through 27?
Well, the answer is we want to have something that we think is realistic for the long term. So that's where we're trying to get to. Right.
Yeah.
Now you could say, all right, I'm going to look at historical data to try and get what the average is. Past repeats itself. You could. I'm not saying you can't. But what I'm saying is if I'm going to do the as is, which is their share price today, right? What I think that the market is doing is they're probably basing on this baseline because this is what the pros are saying, right? But this one, I also will tell you, this is forwarding to next week's content, but the idea is multiples are just rearranged free cash flows. The formulas have to be synced up. And I know the formulas. And when we rearrange the formulas to show you what the multiples are, I am telling you. So just trust me on this one if you haven't read it, but academically, this divided by this will equal that. So we know in the real world today, that based on their stock price, these are the trading multiples. And to get these trading multiples, you have to use that EBIT margin. Okay. I'm not saying it's right or wrong, but I'm saying that that's academically what it should be. So for our purposes, we're going to start here in the as is. Right. And
Okay.
because again, I'm trying to create a baseline based on the current share price. Now, if you disagree with that, and this is the whole point of the target valuation, which we'll get to later tonight, we can always change it. We can change it to what we think it should be. But based on the current stock price, this is what it likely is. If that makes sense, because I'm working backwards from the current stock price.
Okay. And
What
the
cash
reason
flows
for
do you
not
want?
using that same principle to calculate the EBIT margin for 23 through 27.
Well, we could.
Why?
Well,
Yeah.
we could, but I'm usually saying practically most people use forward year 2, forward year 3 multiples. It gets harder when you go to forward year 4, forward year 5, only because of the practicality of getting a realistic forecast for EPS in 2026. Like the more years you go out, the less likely you are to be accurate. So
No, I mean row 13 there. So EBIT margin for 23 through 27. Why would I not use a similar
I'm not saying you
thinking?
can't, but I'm just saying practically we aren't in this class because, as I said, this is really a 2028 margin that we're looking at. We're not using a 2026 or 2027. So we're using 24 and 25 to infer 28. So I'm not saying you can't use 26 and 27 to infer 28, but these forecasts
Okay.
tend to be higher variance than these forecasts. Now, we're still 5 years out when we do this. But I'm just saying for practicality, we tend to use these to infer these more than these because we have better information about these. Other questions? All right. So what we've done so far to forecast the operating cash flows, we've done a tax rate. We've done growth and EBITDA for the next 5 years based on the consensus. We've tried to estimate a perpetuity EBITDA / EBIT margin based on the trading multiples. We have left the balance sheet alone. And this is where this ratio of invested capital to sales, which the last couple of years been in the 50s. Now we are actually improving productivity because invested capital sales goes down to 47 cents per dollar. So we could make an argument that we should be adding more balance sheet here, but I don't think it's that unrealistic of a balance sheet. So that's creating gross investment along the way, assuming Starbucks get a little more efficient out of their stores. But the last number in our model that we have to forecast is the G. The G is the growth in the cash flow / growth in revenue, if margins are the same, into perpetuity. And this is back to our key value drivers. What was our formula for key value drivers? It's the G in the continuing value. That was going to be really critical. And I said, when we started, we're just going to use 3%. We're going to assume that Starbucks grows with the economy. Right now, clearly, if we use that assumption, we are not reflecting Starbucks price because Starbucks is expected to grow faster than the economy. We can see that in the next 5 to 6 years. Like they're not going to grow 3% a year. They're going to grow high single digits, right? To almost double digits. So that's the point. Starbucks is not a mature company. And when we get to the perpetuity period, Starbucks is still not mature. So they're not growing 3% a year when they're in the maturity. The market expects more than 3% a year. That's why in an ideal situation, you actually want to keep forecasting year by year until you get to the point where they're growing 2 to 3% a year. But that might mean we need a 15-year forecast as opposed to a 5-year forecast. So what we're going to have to do is instead of getting down to 3%, we're going to have to adjust the G to be a more realistic G to balance out the fact that Starbucks is not a mature company, that they're going to grow faster than the economy for a while. And their long term is going to have a higher G than 3%. So what is it going to be? Well, here's how we're going to do it for the as is. This formula suggests we need to know for continuing value 3 things. We need a stable WACC for the long term. I don't think the WACC is going to be dramatically different in the long term than what we forecasted here, so I think we're good. Then we need a G and we need an ROIC. In our model, we have effectively forecasted an ROIC when we forecasted the CFI. Because we have a no plat and we have an invested capital. So that's the whole point. Sitting in our model is a forecast. And essentially the 2028 no plat and the 2028 invested capital, if that is a stable year, which means it's representative of perpetuity, then I think our model has probably reasonably forecasted an ROIC in the future. And therefore, what's going to be more important is to get the G right. Right now, if we have the G right, we might have to forecast an ROIC if we think it's going to be far different than our 2028 ROIC. But I don't think that's the case for Starbucks. So for most of our companies, because our year 5 will probably be representative of the long-term ROIC, we know the WACC, we know the ROIC, we need to solve for the G. So long story short, I want to solve for a G that gets me $102 share price. Right? So as I change this G, just as an example, 4%, notice share price is now 65, 6%, 108, somewhere in the 5-ish range is where my G is going to be. So that's the point. The market's not using a 3% G, it's using a 5-point-something% G for Starbucks. So here's the simplest way to do this. For G, we're going to use the solver. Okay. So under this, in Excel, there's formulas. Tools. We're going to use goal seek. Right. So we're going to use goal seek in Excel to solve for the G. So here's how we're going to do this. What we're going to do is we're going to set the cell, the share price, in our model, which is DCF D30, to the share price that I want, 102.13. And we're going to tell Excel to iterate cell B7 off of assumptions until it comes up with a solution that makes our model share price equal 102.13. Now we're going to say okay. And so the answer is going to be 5.8%. That's called goal seek. 5.83 if you want to add an extra decimal place. So rather than just manually typing a G that matches the share price, we've literally gotten Excel to solve for the G that matches the share price. And that's using a process named goal seek. Questions about that? You used goal seek before?
Yes.
You're modeling? Everybody know how to do this?
Professor, yeah, I think the goal seek part makes sense. I think it feels like we were trying to build up sort of organically up to the share price that was advertised or that is sort of publicized, and now we're kind of just forcing our model to produce that.
Yeah, this is correct. We are forcing our model to balance. And what I'm telling you is 80% of the time, the way we're going to force our model based on the formula is these are the two key perpetuity value formulas. Do we think we have a good ROIC? Force the G to balance. Do we think we have a good G? Force the ROIC to balance. Most of the time, your perpetuity ROIC is going to be more reasonable. Therefore, solve for the G. That's what we're doing for Starbucks. Because look at these ratios. These ratios of EBITDA, they're not jumping all over the place year by year. They're in the low 20s. So that's the point. They have a fairly stable ROIC if their margins are pretty stable and their balance sheet's pretty stable. So I don't think that the ROIC for Starbucks would be dramatically different in the long term. If I did, I could change it. In fact, I could change it right here. Because that is the continuing value ROIC. 27%. That's what we're using. If I wanted to make the ROIC lower, 10%, well, clearly I couldn't use that G. I'd have to use some other G. What G would I have to use? Well, 10% would give me a share price of 49. So clearly the market is not using a 10% G at that level of growth. So that's what I'm telling you. Most of the time, ROIC stable, solve for the G. And that's the process I'm showing you here. In your as is, put in the assumptions. Put in the assumptions for WACC. Put in the assumptions for revenue and EBITDA margin. Put in the assumptions for the trading multiples. Put in your margin. Solve for the G. One number I kind of skipped over was the year 6 growth rate, but it doesn't matter nearly as much the perpetuity growth rate. Whether I make this 7.7 or 7, it's not going to change things very much. What's going to change things is getting the G right. Now we could play around with that number, but I still think it's going to be pretty decent growth rate in 2028. So I'm going to leave it at 7.7. Again, questions, comments, concepts, or what we did technically. But what we have just done, and this is an important milestone, save this file, is we have just created what I call an as-is valuation of Starbucks, which basically means we have modeled out the cash flows within some reason, because this is a multivariable model that leads to the share prices. But within some reason, we've modeled out the cash flows that demonstrate the current share price. So we have a pretty good idea, plus or minus a little bit for every one of these numbers, kind of what leads to the share price. That's called the as-is. That's model number 1 that we have to create. From here, we're then going to create 3 more files. Our bull, our bear, and our as-is. So here's the point. This is Starbucks data today. Today they're at 102. Okay. This is price. This is time. I'll use the analysts as an example. The average analyst thinks that Starbucks in a year is going to be at 113. That's their target. That's the average target. That's not everyone's target, meaning here's an analyst today that thinks they should be at 125, 104, 113, 112, 102. This is the average of all their guesses. Right? But I could be 125. So let's say I'm BMO, Andrew Strelzik, and my Excel model thinks they're going to be at 125. So this is where they're going to be. This is their target. Right? So this is 102, that's 125. As is target. Okay. But here's the question. How high could it go? How low could it go? What's the range? That is also important. This is the bull. This is the bear. And this is the target. So we need to create 3 more models with 3 more prices to represent those 3 things. Where do I think they're going to end up? That's the target. How high could they go? How low could they go in the next 12 months reasonably? What's the range? That's your risk. And these don't have to be symmetrical. Bull, BU, bear, PE. All right, so that's what we're about to do. So before we get to the target, I want to do the range. And it doesn't matter whether you do the bull or the bear, you got to do them both. All right, so let's start out with the bull. So here's the idea of the bull. The bull is the optimistic scenario. If things go a lot better for Starbucks over the next 12 months, what could that be? And what would lead to that higher share price? So in order to do the bull, what we're going to do is, first of all, file, save as. I got my as is. Now I'm going to have my bull. Right? So that's the point. I want to take this Excel file and create a bull scenario. And that means two things. One, which ratios am I going to change, or assumptions am I going to change? I'm going to probably change them to be higher, because that's my bull case scenario. And two, why am I changing? So in your next assignment and in your group project, you have to give a rationale for why you change the ratio. You can't just change a number. You gotta explain why in a real world context that you would do this. It has to be somewhat reasonable. So this is where, as I said, the EIC helps for doing with a company. So if I'm doing Starbucks as an example, and I'm doing their EIC, and I read some of the things that the analysts are saying, just to short circuit this, what does it really say that the analysts are saying about Starbucks that is important, right? So number one, they're repositioning some of their stores and they're spending on tech to boost sales. Secondly, China is a big market for Starbucks, and how fast they grow in China is going to be very important to their long-term success. And so we got two things. I got to figure out inflation and costs, right? And I got to figure out whether or not that their, consolidation in the US, chopping up some unprofitable stores to boost margin and kind of focusing on cost, how that's going to play out long-term. And I got to play out their long-term growth outside the US, particularly in China, and how fast that's going to be. So let's talk about the bull scenario. In the bull scenario, two things start to happen. One, they get, because they've downsized a few of their underperforming stores, they've actually improved their supply chain. Inflation has come under control. They actually get their margins a little bit higher than what they did here that the analysts were expecting. So in my optimistic scenario, two things. One, in perpetuity, I think they get closer to the 22.9% margin, not the 21% EBITDA margin that we originally had, right? And even in the next couple of years, they might get this to be a little bit higher. This might go to 20%, and this might go to 21%. And for growth, because we're selling more in China, their long-term growth might be a little bit higher. So I'm going to make this 8.5% in the out years. And my G is not going to be 5.8%. I'm going to say it's going to be 6.5%. So more sales, particularly in China, give them a longer runway into perpetuity of growth, a little bit higher per year. Because remember, this is compounding, so that's going to have a big impact. And they're going to do it slightly higher margins. So what does that mean? What that means is their share price, if that all comes true, could be $146 a share. So my bullish scenario for Starbucks says that they have upside to as high as 145 if all those things go right. That means all those things have to go right. I'm not saying they will go right, but they have to go right in order to be that scenario. And that's going to be my optimistic scenario for Starbucks. So that's my bull, 145 point. Questions about that? Where it came from, how I made those assumptions, what I changed?
Is that the price we think it should be valued at today, or in?
It's what we think they could be valued in the next 12 months if a lot of things go right. And I explained what I think would have to go right, like really right. So that's the optimistic scenario. Rose-colored glasses.
Could you go up a little bit real quick? Just to see what,
So what I did is I upped a few of these margins, particularly in perpetuity. I upped that year 6 growth rate a little bit. But what I really upped is I made this number 6.5. That had the biggest impact. Just very long-term perpetuity higher growth. Gave them an extra 75 basis points. But more importantly, I told you why. I told you why I made those changes. So that's the thing. When you guys do this, it's not just changing the numbers, it's your rationale. You got to put both. So when I say write a paper about this, that's what I mean in the paper. Here's my scenario for the bull. Here's what numbers I changed. Here's why I changed it. Here's my scenario for the bear. Here's why I changed it. And here's what I changed. Here's where I think they're going to end up, which is the target, somewhere between the two. Here's why I think this is where they're going to end up. This is my opinion. And this is why I have that opinion. And you need to put that in real world context. David?
Can you give a little guidance on how is it that we actually like the magnitude of our changes? So you said 75 basis points. Why not 50 basis points? And how do we
Well,
make that?
The short answer, and this just comes from my personal experience working with cash flows, is this is why we do what's called sensitivity. Meaning, I'm going to start to want to see two things. One, what does 1% G actually do to my stock price? And you notice it has a very big jump in stock price when I do 1% more G. So on the one hand, I want to have a sensitivity, like when I change something, what is the magnitude of the change? And then two, I want to kind of be realistic in the real world. And what I'm just telling you is it's going to be a little bit more incremental. But to understand what is incremental, you have to understand sensitivity. And so that goes back to, do I really think Starbucks is going to more than double their stock price in the next 12 months? Probably not. I don't see anything in that growth rate. Like if you're growing 10% a year, your margin's going up 1%, your stock price doesn't double. You're just not going to get the cash flows to do that. So that's where I said you kind of get a sense of, all right, well, what does that mean if they go up 10, 15%? What kind of G would that be? You kind of do a little sensitivity in your model, and then you kind of work backwards to, all right, a little bit more growth in China for this sensitivity gets me $10 share price, $20 share price. That seems more reasonable. That's probably a more realistic G. So that's why you have to do what I'll call the sensitivities. Now I've kind of skipped over that process because I have a sense of the sensitivities for companies based on these margins, but that's something that you'll probably need to play around with as you're doing your homework assignment for next week.
Okay, so are we saying that increasing their growth rate by that much is just completely impossible, or are we
I'm
say?
not saying well, give me the story. That's where I go back to, you also have to have the data to support it. What would allow Starbucks to see their growth rate substantially grow that much more forever? I mean, what markets are they not in that they're going to dominate so much more and grow so much more that they're not? I mean, it's basically Dunkin' goes out of business and they take all their customers. Is that our scenario? That suddenly the US is going to buy twice as much coffee as it used to? I mean, like what's going to change that's going to cause them to sell so much more? We'd have to have a story to support that.
Professor, can I ask you a question?
Yeah.
In your 5-year projection, you're doing a 5-year projection of discounted cash flow, and then you're doing 6 years, the out years, the continuation value. In that situation, is there like kind of an upper bound on a perpetual G for like even the highest growth rate, most possible,
One is math. Your G mathematically can't be higher than your WACC.
Right. Okay.
So we are bounded by this because mathematically, if your G is higher than your WACC, then you end up becoming the world.
Right.
Like you just push everybody out, and nobody will invest in anybody more than you because you're growing faster than your WACC, and it just doesn't work out mathematically. So you're bounded by the WACC. So that's one boundary. But the other is just a reasonableness test. And I will talk to you when we do multiples. Multiples are another way to look at a reasonableness test next week. So back to, what would the trading PE be if Starbucks stock price was 200? What do we have here? I'll put this back to 6.5. At this share price, 145, what's their PE? Well, 145 divided by about $4 a share next year, that's gonna be a PE of 30 something. Right? Whereas if I go to 7.5, and I get my share price in my model up to 262, 262 divided by 4 is what?
Lot.
60. So what I'm saying is, are institutions going to pay 60 times earnings for Starbucks? Their P is going to be 60. And I'm just saying, I don't think that's reasonable. I don't think anybody's paying 60 times earnings for a company in Starbucks situation, McDonald's, Starbucks, whoever that's somewhat mature. So that's the point. Like, you can actually triangulate the multiples, which we haven't got to yet, to kind of help you understand when you're unreasonable with your share prices, right? Because people aren't going to trade, and I'll give you a different way of looking at this. These are Starbucks competitors. And based on today, these are the forward PEs for every one of their competitors and the industry average. The industry average PE next year is 26. Who would the market pay 60 for? Right? If I'm a $250 share price, right? A 60 PE is a tiny company like Wingstop, which is growing very rapidly. That's it. There's no other company, Shake Shack's an anomaly. There's no other company that trades at 60 times PE in the second forward year. And so that's the point. Like, no one's going to pay that. So therefore, that would be an unrealistic bull that nobody would believe. It's just too bold. So they just can't have that level of growth. So that's where we would kind of use the triangulation to do that. But going back to, so, could they pay 35 times? Well, it's a little bit above the industry, but it's not crazy. What would lead to that? And that's why it goes back to the story that we tell. So that was my bull. So I saved my bull. I then close this Excel file.
Professor, quick question before you, okay, never mind.
Okay, what was the question? Pull it up.
The no plat assumption, could you just, is there the cell B5?
This one is
a
just,
formula there?
That's just part of the continuing value for what I think my no plat is. But what's going to drive that no plat is really this EBITDA. So we've kind of handled the no plat by forecasting the perpetuity EBITDA.
Okay,
So when I raise the bull EBITDA slightly, it actually raised that year perpetuity no plat.
could I take a look at that formula one last time?
Which
You
one?
had no plat, the one in the assumption tab.
Well, the assumptions tab for this no plat is just our TII M5, which is the 2028, the final year no plat. And I'm just telling you that final year no plat is based on that ratio. So that ratio is going to create that number. So it's the ratio that was more important to driving that no plat than overriding.
Understood.
We kind of created it. All right, so back to save my bull. I then open up my as is, file, save as, bear. Now I put on my pessimistic hat, right? What could go wrong for Starbucks in the next 12 months that would actually start driving down their stock price? Well, a couple things. One, inflation remains higher than expected for a couple of years and even long term. Number two, China growth slows dramatically. Trade war fight, they just don't have success in penetrating the Chinese market as much as they expected. So a lot of that growth just doesn't occur outside the US, right? And there is far more competition for higher end coffee, McDonald's, Dunkin', whoever. So they don't get the price increases and they don't get the market share increases. And their drive into the food business isn't as successful. They just mature a lot faster. So let's say this long-term growth rate is closer to 5%. Okay, and the margins in 2028 look more like the margins pre-pandemic, 20.9%, or even middle of the pandemic. So I'll use 20.9%. The margins are lower long-term, not higher. Right? And the growth rate is slower, 5%, for reasons that I just said. Well, now their share price could be as low as 73. Right. So that's my bearish scenario for reasons that I just said, and that's what I changed. Lower margins, lower growth, lower long-term G, because they just can't grow as much in a more competitive market, and they don't get the price increases relative to the competition. That would cause their stock price to be 30% below where it is today. So I now have a range. I have a low end of the range, and I got a high end of the range. Low end of the range is 73, high end of the range is 140. That's where I think somewhere in that trading range, I think Starbucks is reasonably going to be in the next 12 months. So then the question is, where in that range do I likely think they should be?
Professor,
Go ahead.
sorry, Professor, can you quick scroll up to your assumptions for this again? Your ratio assumptions.
So what I did primarily is very quickly, I lowered this and I lowered that.
Thank you.
And the real important one is I dropped that. I dropped the G, which in our as is was like 5.7, 5.8. I dropped it down to 5%, which still says they're going to grow. They're just not going to grow nearly as much. And they're going to grow at slightly lower margins. And by the way, that knocks off 30% of their cash flow value.
Right.
And I don't know if you remember, but like in the pandemic, their Starbucks stock price going back go back 10 years. There's their long-term stock price, but their stock price was $20 a share not too long ago. It was $40 a share in 2015, $60 a share. So getting down to that level, they went to 60 during the pandemic. So I'm just saying, like, you know, could their share price drop to 60 or 70 a share? It's done that in the last 2 years, did that last year. So this bear scenario is a potential bear scenario that's realistic, right? So that's what I'm saying. I have a scenario that says they go back to this range. I got a scenario that says they get up here. And I explain why each of those scenarios I thought could occur. So now the real question is, where do I realistically think they're going to end up? And if you look at the average analyst today, this is their targets. You can see 102 is the current share price. Every one of these analysts think that they're going to probably be more above the current share price in a year than below the current share price in a year. Right? So that's the point. They're more towards the positive side of Starbucks than the negative side of Starbucks. Now, I don't have to agree with that. I could be an outlier, see if there are any outliers. There's not a single analyst that says that they're up. Here's one. DZ Bank, who hasn't adjusted their target since May, thinks they can go down to 95. All right. So there is one analyst who thinks Starbucks is going to be lower than a year than they are today. The other 20, whatever, 30 analysts think they're going to be higher. Some much more higher than others. So that's the question. Where are we on this? What is our scenario? So again, I go back to save my bear. I go back to my as is, because that's kind of today. Right. So what do the analysts think? They think it's going to be a little better. Do I agree with them? I could say no. I just call my as is my target. Right. Or I could say, you know what? Maybe they're right. Maybe Starbucks is going to continue to improve. Like their founder coming back in, consolidating the stores, you know, their international growth and hooking the Chinese on caffeine as much as we are, seems like a reasonable story to me. So maybe I'll give them a little bit more credit in the out years for margin. And maybe I'll give them a little bit more growth to closer to 6% long-term. And I'll call that a 111 share price. So that is my target. The important thing to the target is has to be below, in between your below bear and your bull. Can't be below your bear and it can't be above your bull. Because otherwise the bear and the bull wouldn't make sense. So my target is, say I'm slightly above analyst average 110. Today they're at 102. So here's how you do a buy sell hold. If your target is within 10% plus or minus of the current share price, that's called a hold. It's a trading range. What's 10% of 102?
10.2.
So is this a hold? If my target share price is 111, is that
That's a hold.
It's a hold. If your target share price is more than 10% above the current share price, that's called a buy. And if your target share price is more than 10% below the current share price, then that's called a hold, a sell. That's the buy sell hold. That's exactly how they come up with their buy sell holds. So that's the whole point. You come up with a price, you compare it to the current one, creates the buy sell hold condition. The price is based on where you think they're going to end up in the next 12 months. And the reason why they use the next 12 months is because you can't get sued. If you said where they're going to be tomorrow, you're more likely to get sued. All right, that's been a lot. We've been going on for an hour and 45 minutes. We need to take a break. Questions about any of this? So what you needed to have done conceptually is to have the structure to finish doing everything we did and the idea to create these 4 models. When we come back from our break, I'm going to give you data for another company and see if you can complete this before we end class tonight. So we're going to practice one. And then your next week homework assignment is you're going to do one. So I'm going to give you a company to do. So everything we did in class today, you're going to do for homework. We'll practice one more when we get back from our break. So questions before we go on break? All right, 10 minutes. Let's start back at, we'll call it 8:30 Eastern. I'm going to stop the recording and we'll see everybody back here at 8:30. All right, let's go ahead and everybody's starting to come back. Turn on your videos.
Professor, sorry, if just one quick question before everybody jumps back in, and sorry to get stuck on this, but the continuing value growth rate, right? When we use Solver to get to that point, I'm a little worried about the integrity of that as the number that we're basing everything else. It seems to be the most important value variable in the whole model. Yet we didn't really have data underneath it other than other analysts' prediction for what the share price should be to get there. Like that's, I'm struggling to sort of reconcile, like where is there a better source of data for that? How do we feel that 6% is a good number versus 5% versus 5.5% versus the 3 that we originally had?
The short version is you should be concerned because it's typically the biggest driver of the continuing value. And for reasons that you just said, it's ironically one of the harder ones to probably estimate. So again, that's why I go back to ideally you want companies to be mature. So that way your G is close to maturity and you're not worried about, the difference between 4, 5, 6%, which has huge impacts on the company. So it's harder to do a GE for a faster growing company. That being said, that's also why we use at similar margins, growth in revenue as a proxy for growth in margins and cash flow. So it goes back to trying to figure out what is a reasonable growth rate for a company in an industry to kind of give us insight into what that G can be. But even for a company, the difference between 3.5 and 4 can have huge implications on its value and its stock price. So there is no really easy answer, because this is a challenge even in the real world, is to get that G to be realistic as much as possible, knowing that slight changes and it can have bigger amounts. That's what I'm going back to. I think it's helpful to start with the process I'm suggesting, which is, okay, when you do the as is, we can kind of back into a proxy G that at least is giving us something in the ballpark of what would have to be necessary to support a stock price. And then we can kind of make variances from there, as opposed to a generic, let's just start by putting what we think the G for the industry is and then build our valuation model, which is what some people do. And as you said, you could be way off because it has such a huge impact in the model. So I'm not saying it's going to give you a right answer, but that's one of the reasons why I'm suggesting this approach. Now, again, because we're dealing with traded companies that are public, and we know that multiples are rearranged math, I'm also going to give you another method next week when we get into multiples to help further estimate and refine the G. But even when we do so, it's going to be a range by definition, because all these variables affect each other. And the only other thing I would just say is that's why we do sensitivity. Play around with the G a little bit, play around with your ROC amount, see what it does to the stock price. And you really have to almost do like a reasonableness test on what you think is reasonable, because you can start to see the compounding effect of these variables when you start playing them out. And then you can quickly get to some very unreasonable values. So I don't have a right answer, but I think you're spot on in calling that out as a big driver of any valuation. Right. Other questions before we go forward? All right. So did team one pick a company yet? Talking amongst yourselves?
Yeah, we were working on a couple options, but I think we're close to finalizing it.
Okay. So is one of them Amazon?
No.
Okay, so then we're going to practice with Amazon, right, as a group, right? So what I want to do is I want to take our Starbucks model, and in class here today, I want you to do an as-is valuation of Amazon. Okay, so that will be your goal, right? Now, in order to do so, I have put here in the files folder, a folder while you were on break called SBucks. And these were all the Bloomberg screenshots that I took. So think of these as like your roadmap, to the data that you put in your file. So I'm going to put similar screenshots in here in a folder called Amazon. And your goal is going to be to use that data to update the model for Amazon. Okay. Now, what do we need to update? This is going to be the most important part. I'm putting the file in called Amazon data. And I am going to share my desktop again because it's easier. Take some screenshots for Amazon as of today. AMZN. All right, so here is Amazon's share count right here on the DES screen. Here is Amazon's WACC today. And across all these screens are the current share price, 128.21. here is Amazon's estimates by the analysts. Which include the trading multiples for the first 4 years. And I will jump over one column. So you also have the data for Amazon for year 5. Which is 2027. So, this is, as you do your bull and your bear, summary of what the analysts are saying about Amazon today. And I know it's just very high level, but at least gives you something to play around with. So I'm going to download that file. And then the final thing I'm going to do is see if Amazon has any guidance on tax rate. They have not provided any guidance on tax rate. So what I'm going to do is I'm going to take a JP Morgan analyst report where JP Morgan here, which has one of as on August 1st for Amazon, and they're going to have a tax rate in here when they forecast the company. Sure, it's here. Yep, it's going to be in here. So I am going to download those 2 files for you. So this is the JP Morgan report. And this is what I'm going to call the company outlook. These will also be files that you will get for each one of the companies that you have selected for your team project. Okay, so it's important to know what they are. So I'm going to take all of this data that I just downloaded. For Amazon, and I'm going to put it into this folder called Amazon. So the only other file that's important in here is this one. The Amazon data file and the here's Excel file open. I'm going to take the Starbucks as is. All right, so here's the deal. Model data. This is the raw data of historical data for Starbucks. It makes the Starbucks valuation the Starbucks valuation. We're going to use this file to value another company. This is the idea of a reusable model. So if I'm going to do Amazon, file, save as Amazon. First files can be my as is. So here's what matters. Row for row, cell for cell, I need to basically take all of the Amazon historical data and overwrite the Starbucks data. So the easiest way to do this is to select all of the Amazon data that I give you, select the whole tab, copy it, come in here to the model that used to be Starbucks, that renamed Amazon, select that whole first tab, right click, paste special values. So that will overwrite all of the data that used to be Starbucks historically, row for row, with the Amazon data. So now, and I check my CFI to make sure it still balances. Right, because that will tell me if I have a data problem, which you won't. Okay, so, but here's the point. Remember that these ratios still have some legacy Starbucks data in it. Like we had typed in revenue and EBITDA for Starbucks. Amazon's a much bigger company. So I'm gonna get some really wacky ratios if I don't update things. That's why we got a hard code and reuse. This is Starbucks whack. I need Amazon's whack. This is Starbucks shares outstanding. I need Amazon shares outstanding. This is Starbucks current share price. I need Amazon's current share price. These are 5 years of revenue for Starbucks and EBITDA for revenue. And EBITDA for Starbucks. I need to overwrite that with the Amazon data. There's the multiples for the next 2 years for Starbucks. I need to put the multiples in for Amazon. For the ratios, I need to put in the EBITDA in perpetuity for Amazon. I need to make sure I have a tax rate that's reasonable for Amazon. And then I got to solve for a realistic G for Amazon such that I will match their share price. Okay, that's the idea of doing a reusable model. So in order to do this, I'm going to create my as is, and then I'm going to create my bull, my bear, and my target. Okay, it is 8:42. I'm going to give you 45 minutes, and I'm going to put you into teams. And I'm going to ask your teams to create those 4 files, work together, right? So pick one of your models, or you can all do it if you want to do it simultaneously. But basically, in 45 minutes, I want you to tell me, what is Amazon? Show me their as is. Show me that you match the share price. Show me their bull, your bear. Show me your target. Talk to me about why. This is your homework for next week, except it's not going to be Amazon. I'm going to give you another company. But we're practicing doing this in class today as a precursor to your next assignment. All right, so is everybody clear on what you're going to do? All the data that you need to complete this file, with the one exception of the core valuation model file, is in this folder called Amazon, and I just uploaded it. So questions before I send you out, and I'm happy to work with your teams as you're working on it. I'm going to put you into random teams. What your task is over the next 45 minutes. Okay, then let's put you into teams and get this started. Rooms, put you into 5 rooms. 45 minutes. All right, good luck. Okay, welcome back. I was kind of circling around the rooms. Looks like everybody made some good progress. How about we start with the as is, and why don't we have one of your teams share your screen and kind of walk us through what you did, just to make sure we all did the same process. Any team want to volunteer?
I can go ahead.
Yeah, go ahead, Kelly.
Right. All right, so we uploaded our data into our model, and then we went ahead and used the Bloomberg screenshots. You guys see my screen, right?
Yes.
Okay, and then we use the Bloomberg screenshots to adjust the values within. So we started with adjusting the estimated revenue and EBITDA to get our EBITDA margin, which then flowed into our ratios tab. And then when we calculated our EBIT margin into perpetuity, we used the 7.2% in our operating margin. So then when we went back to our ratios tab, we adjusted our EBITDA to 15.4 to get an operating income percent of 7.2.
Okay. Where'd you get the tax rate?
The tax rate we got from the JP Morgan report, and we used 9.9.
Okay.
And then we utilized GoalSeek to find our G, which ended up being 9.5%, which is lower than our WACC, which appears to be reasonable.
But if you think about this as a compound annual growth rate for the next 30 years, I mean, you know, what we're saying, what the market seems to be saying at the current price is Amazon's going to be growing for a while. They're not going to be that, they're not going to turn into a, you know, a 2-3% grower for a very long time. That's what's expected about Amazon. Right or wrong, that's just the view. And you can kind of see that when you look at the EEO screen and even the numbers here for revenue. I mean, Amazon, you know, it's going to be 50% bigger in the next 3 years.
Yes.
So a lot of growth expected at Amazon.
Yep.
All right,
Sorry, we forgot to update that number.
we're update which number?
Operating cash of revenue.
That one we could probably leave at 2% for any company. It's not going to change.
Okay.
Can I ask one question about that? Are there like known like exceptions to that? Like say, for example, Apple that keeps a tremendous amount of cash in reserve?
Well, you gotta be careful about your question. So if a company
Operating
keeps a lot of cash in reserve, what is that?
Not operating cash.
Exactly. So what we have to do is we have to go past that and we just say, okay, how much cash does a company need on hand to run the operations day to day? Could a company need more than 1 week of cash? Absolutely. Some industries, like for example, in healthcare, you know, the rule of thumb when I work with hospitals is they need 30 days of cash. If a hospital's healthcare system goes less than 30 days of cash, they really struggle to function. It's part of because the payment cycles takes forever to get paid by payers and governments, whatever. So they have long cash cycles to run their business. So they actually need operating cash to make payroll, you know, pay for equipment, employees, etc. So they'd actually probably be much more than a 2% of revenue. But that's why, you know, the book talks about, you know, either doing some regression analysis across peers in industry to figure out operating cash, or as I said, practical approach to the real world, just kind of talk to the company themselves. Talk to any respectable CFO, treasurer, controller. They know how much cash they need to keep in the business on a going basis. And so a lot of the analysts will just ask, you know, what's the reasonable cash balance that you're going to have to keep, so they can estimate discretionary cash above that. But for our purposes, we're going to kind of use 2% as a, you know, simplistic placeholder for this class. That's a week of cash. That's what we were using in the original model. All right, well, I think you guys captured what we needed to do with the as is. And again, I think you solved for a G that got you to the $120 share price.
Yep.
Which again is pretty high G, about 9.5%. All right.
Yes.
And again, why'd you choose the EBIT margin at 7.2? Why not lower in the range?
We were just thinking that they've been doing fairly well, and then when we looked at like the other ratios, they seem on the higher end. So going from an 11.6 to a 5.9 was kind of extreme.
Okay, but if you look historically, you know, they were in the 5s. That you just don't see them returning to where they were 5 years ago.
Yeah,
will.
just because I think post-pandemic and everything that's happened, I think a lot of people transitioned to Amazon, and now it's kind of more acceptable to everyone, including like boomers and stuff. So I think going forward, if anything, they're just going to keep growing.
Okay, but what's important about that is not the answer to my question, but the assumption that you're giving when you do that. And that's what I want you to also understand. Like that's both in the real world as well as this class, really, really important is don't just put a number in there, give a rationale for why you're putting the number and you know, make sure that it sounds like a reasonable rationale for why you're saying what you're saying. But I guess that's the point of the models. Like, you know, the whole idea of the model is it's garbage in, garbage out. But the other part is, you know, the model's just a spreadsheet. like what makes the spreadsheet. That's much more important than the spreadsheet itself. So that's what we got to continue to practice on as we go through that. Appreciate you giving that clarification. All right, I assume everyone else got numbers
Question.
similar to this. Go ahead.
Question on this. For the as-is model, since we do end up reverse engineering that G value.
Yep.
If we assume the, 7.2 instead of the 5.9, ultimately, if we had instead chosen the 5.9, that would lead to a higher G value. And if that's also seen as, if that's seen as less realistic, then the EBIT margin, it's kind of this circular, well, which of these do we choose? And I guess that's where the other valuations really, you can make those finer points.
Well, if you go back to your DCF tab, click on the DCF tab. I think you have it on here. You see that formula? That's the trade-off that we're working on. So in continuing value, there's a trade-off between ROIC, which is represented as RONIC, and G, growth and ROIC. And so that's the point. In the model, what's driving the ROIC? It's our margin. Higher margins, higher ROIC, lower margin, lower ROIC. Same capital, different profit, change ROIC. So that's the question. If you have a lower ROIC, you need a higher growth rate to get to the same value. If you have a higher growth rate, you don't need as much of an ROIC to get to the same value. So it's a paired combination that leads to the value. And that's what makes it, and that's why I don't have a good answer, but the real, and that's why understanding of this is more important. The sensitivity of these is kind of important to understand. Like, do I think that my ROIC going forward is more reasonable? Then solve for the G. Do I think that my growth is more reasonable? Then solve for the ROIC. Like, I could give you a company right now that has terrible ROIC historically. Good example, take like an airline, right? Or some of the travel companies, hotels, right? And if you're trying to estimate their ROIC, it's really hard because they're still, in some cases, climbing out of the pandemic. Like last quarter, they're starting to do really well, but over the last year, their numbers don't look so good. And there's some questions about what airlines are really going to earn in the next few years. They're having some good times right now, but fuel's going to play a big role. That's 25% of their cost. What's going to happen to oil prices? What's going to happen to capacity? They're all starting to add a bunch of capacity. Once it comes back online, is that going to drive a much more competitive industry? There's a lot of uncertainty. So that's the point. Like in an airline industry, you might have to forecast the growth and say, all right, the airline's going to probably grow 3 to 5% a year, and then back into a more reasonable ROIC in your modeling, just because the ROIC is much more uncertain than a company like an Amazon or even a company like Starbucks, right? Which is probably a more stable margin going forward. I mean, I heard a couple of people say, oh yeah, their Amazon's not going to see big jump in revenue in 5 or 10 years. You can see that with an airline. And so that's the point. Like it's that paired combination, but nonetheless, that's the key to value. And unfortunately, that paired combination drives 60, 70, 80% of a company's value in the perpetuity stage. So getting that right is important, but it's actually kind of hard. That's why you got to figure out what to do. So I'm telling you, most of the time, it's easier to forecast. All right, this is the base ROIC. Therefore, here's what's the growth. That's the process we're starting with. But nonetheless, trade-offs between what you think those margins are, it's going to drive different growth rates, as you said. So I want you to just understand that, nothing else. So we go through the modeling part. Finance is more art than people realize. Everything is a science. Formulas are science. What you put into the formulas, that's the art.
Professor, a quick question. I assume the answer is no, but there's no way through Bloomberg we can see what analysts or the industry or whatever Wall Street thinks the perpetual growth rate of Amazon is. See if it's anywhere near 9. Is it? Is there?
The answer is yes, because for the sell side analysts, they're literally uploading the spreadsheets that we're working on to Bloomberg, and anybody can download them for a price.
Right.
So we just can't afford it, because that's the whole point. That's why I told you they sell $4 billion a year of sell side research. That's part of what they'll sell. they'll sell their Excel models. And you can literally download their Excel models and see in great detail what their assumptions are. But you gotta pay for it, and we don't pay for it. So absolutely you can do it. All right, so how about a different team? So thank you, because I think all of our numbers are gonna look similar to this. Why don't you go through your bull and your bear? So somebody else talk to me about your bull and your bear.
Sure,
I'm
I
happy
can
to,
take it, or go ahead.
you go, Gabs. Oh, I will, okay, right. I will share my screen.
Or one of you can do bull, the other can do bear. That's fine with me.
Sure. Yeah, I'll do bull for team one.
Okay,
Um,
talk to me about your bull.
yeah, so I think quite obviously the number that sticks out is the continuous value growth item here, which is we felt like given how close it is to the WACC, we didn't really want to project too much higher than that. We felt like you get to a point where it's unrealistic, so we only pushed that up just a couple of points. And then on this side here, we made some adjustments to the EBITDA numbers on the early years, but most importantly here on the in the 2028 year, we pushed that up about a point as well. So that's really where that our assumptions came from. We feel like it would be a little bit more efficient in the future in terms of I guess the growth that they see, but they're going to be improving in their operations as well. So we hope that that's where.
But what about their operations? What's the delta improvement that Amazon would have to experience to achieve what's here? What about their business would be even better than expected?
I guess just managing costs better.
And I know we're not getting too granular, but like, is it managing cost on their what? For delivery? Is it for AWS? Like, is the driver AWS? Is the driver just the online e-commerce business? Like, what is it? What's going to be better?
Good question. The probably the driving and delivery costs, it would be tough to make sort of a notable bump in that. Efficiency in warehouses or in I guess supply, maybe there's a little bit of improvement that they can make there. The cloud, on the cloud side, hard to see sort of any major sort of cost wins that they could make off the bat there.
So back to
yeah.
your cost side on the supply chain. Let's assume it is on the e-commerce supply chain side. What's your view on inflation long term? Is inflation now under control? It's back to 2% a year. Is inflation going to remain high, higher than 2%? Is that going to be a problem that Amazon's going to have to deal with?
Yeah, I guess in the same way that we saw it last week, the week before with Costco and Walmart, like that.
But if you're doing a bull scenario that says higher margins, what does that infer about inflation's impact on their supply chain long term?
I guess it's saying that we expect inflation to come down and that we think that it's going to play less of a role in the future.
So this is what I talk about when I say I want to hear about your assumptions, because whether you're saying them tacitly or whether you're saying them out loud, you're making some assumptions when you put the margin higher. You're making some assumptions that would cause the revenue growth rate higher, or you're just being completely arbitrary. It's possible too, but I don't want you to be completely arbitrary and just say, oh, I got to find a way to make it go up 20%. Like, that's not the goal of a bull, just to make the share price 20% higher. It should be like, what would cause it? What about the real world would be, for whatever company it is, would cause a difference in what they do. And Starbucks, it was like, that's why I gave you the analyst report summary. They really have a cloud over what happens with China, and how fast they grow in China is going to actually be a big driver of Starbucks stock price. So what is the driver for Amazon? And I think it goes back to what's going to happen with their cloud and their cloud revenue. And I think it's how fast and continue do they get e-commerce and some of the related businesses that they're now into, particularly grocery stores, and how successful is that? Because, if you read about today, they're reorganizing their grocery store businesses, and they put it under a guy they hired that worked for Tesco, I believe, which was a British grocery store chain, to kind of run the Amazon grocery business and consolidate it so that it would grow. But now they're, Kroger and all those other companies are starting to fight back, because they're not just going to let Amazon take all their revenue. So what does that mean in the context of your bullish model? So that's where I want to, a little bit of a click down, even though we're not making that level of detail in our class, but we should at least have some
Yeah.
inference at a high level about that. So when I go back to your homework, that's what I want you to tell me. Like, I don't want you to just change the numbers. Process, yes, you guys are starting to get the process. But what is the assumptions? That's that art evaluation. Why are you changing something? That's what's important to me, that you start to at least try to articulate as you go through this. All right, somebody give me a bear. I got 191 bull, a lot of upside for Amazon.
All right, I can do that.
Transparently, and this has nothing to do with this class, but I actually personally own Amazon stock. I'm very bullish. That's not a reason to buy. That's academic comment. Past performance is no guarantee of future performance. Don't just buy it because I own it.
What's your super in-depth bull valuation model, target price?
I'm not going to put that on video, but I'm just going to say that I am bullish on Amazon long-term personally.
Well,
Could be
maybe when we before we end the class, you can turn the video off and recording off and tell us.
I'm just telling you, I own them at today's price, and I'm still optimistic about it.
We might have jumped in if you hadn't told us there's so much artistry in finance as opposed to.
There is, and I could
Right, but-
absolutely be wrong, and Amazon could fall off a cliff, and I don't want you to lose a bunch of your college money because I told you to buy Amazon. So, not making that recommendation to you. All right, where's your bear?
All right, so very similar numbers from Chris on the bull. So in terms of the growth, we also thought we decreased it, slightly the same amount that we increased it, essentially to like 9.75. So on our bear scenario, we decreased it to 9.25. And then on our ratio stab, we we hard coded lower values for the EBITDA. And again, that could be very, just based on historical supply chain issues that the market has gone through pandemic, but hasn't fully recovered from. Like you mentioned, inflation and things like that, or just more competitors taking more market share could lower some revenue growth. So that's why we also reduced this one to 9.5. On the bull scenario, we took the average, which was like 11.5. And then one thing that we did change as well, we didn't know. So we also use a 9.2% for the tax rate, which was from that report. But then we figured that with the new administration, or regardless, one digit tax rate for a company like Amazon, someone eventually will say something about it. So we figured that we use 15%, which is currently the discussion being held on the minimum global corporate tax rate. So we increased that at 2025 and onwards.
Yeah. And that's a big deal, as you can see, is what the impact was on your stock price. So it goes back to what would cause tax rates to be higher. Who wins the 24 election? That could actually have a big driver here. And who controls Congress in 2024 could have a big impact on what tax rates are, because obviously the two parties have a differing view on what corporate taxes should be. And under the more Biden view, where everybody should pay their fair share, 9% is not going to be acceptable. And he's got this kind of alternative minimum corporate tax that they've been pushing. If that plays out, you're right, 15% could be very much reasonable. I mean, corporate tax rate is 21, so 15 is still better, but that has a big difference on Amazon share price, and that's a big driver down. So, important to call that out, but back to clicking down a little bit more, like, why did you raise the tax rate? I'm giving you rationale that maybe you did or did not talk about in your teams, but that's what I want to hear from you guys. Why you did this? What causes this ugly scenario? What causes that growth rate? That's the other thing. You're driving most of the share price down by taxes. You're not driving it down by big drops in margins. You're not driving it down by really that much slowing of the growth rate. So that's a key point of your assumptions, whether you realize it or not, is that you don't think that Amazon is going to slow down its growth, even in a more pessimistic scenario. And I want you to articulate that. When you do your write-up. All right, somebody give me a target. Where do you think Amazon's gonna end up? Where'd your teams, who got to the target and where did you actually put them on a buy, sell, hold? Any of the 5 teams get to a target?
We ran out of time personally.
Any of the other 4 teams get to a target?
Well, for our group, we didn't get to it because we were out of time. Well, we did discuss that we expect it to be in the range of 140.
So you're on the more, it's gonna be higher and probably a buy. Even though the math isn't quite there, but that's where you think the math would probably lead you when you put in your assumptions. Okay, what do the other teams think? Like, do you think Amazon's fairly priced? Do you think they're undervalued at this price? Good time to buy? Do you think they're overvalued? Good time to sell? Do you think they're appropriately valued? Like, do you have any thoughts as you started playing with these assumptions? Any assumptions scare the hell out of you? I mean, I implicitly told you 5 minutes ago that I think Amazon's a buy.
I think the nine, like the high 9% continuing value growth rate's the one that's like, that seems really tough to swallow. Like that's a very high number for a continuing value, and it's just hard to sort of picture any world where somebody maintains that competitive advantage over, you know, the sustained period.
And that's important to remember as well. I mean, a lot of these companies are what are called price to perfection. You saw some of those forecasts, you put them into your model. Those are numbers at scale that are at scale. And that's the point. Like, those are hard comps to meet. And at the same time, hard comps to sustain for years on end without competition affecting us. And we know that there's regression of the mean that comes to most industries. So will that play out for Amazon too? Or are we being too overly aggressive in the continuing value period? I mean, these are really important questions that don't have direct answers, but we should always be asking ourselves that as we do this. All right, so back to, I know we're at the end of time here today. Does everybody understand the process that we went through to create these 4 files? Does everybody understand that I have an expectation that when you go through this process, that you have to write up and explain your rationale for changing assumptions and what examples of that might look like? Okay, so here's your next week's homework, individual or in pairs. And somebody even talked about inflation. Absolutely. Inflation staying high versus low. Economic factors play into Amazon and probably affect them, as will distribution costs. I mean, UPS just went through a big, fight with the Teamsters and gave them giant pay raises. Is that going to affect Amazon drivers? I mean, just all these things will start affecting the companies that we look at. All right, so there's a company that you probably know a little bit about called Apple. They're reporting their earnings tomorrow. I want you to do them as your next assignment. So while you guys were working, here in the files, well, assignments, it's also in the files folder for week 5, Apple. So basically 4 files, as is bull bear target. Write a paper. I put minimum 500 words with the idea that you're going to be writing up all 4 of these assumptions as you go through each of the models. Like, why did I put in the assumptions that I did for each of the models, right? Write that up, okay? And then basically turn in those 4 Excel files in your Word document, the bull, the bear, the target, the as is, plus the word explaining your changes and assumptions through the models. And that's your assignment for next week, doing individually or in your study buddy pairs. All the data that you just had for Amazon, I've recreated and put up here for Apple. It's either on the screen or in the file section. It is here in a folder called week 4. All right, so that's the goal. Any questions about your homework assignment for next week? What's going to be expected of that?
We have all the data up there now, but you said they report earnings tomorrow. Obviously, we're doing it based on.
Yeah.
based on tonight, not based on, the next 6 days, right? Yeah.
Based on tonight. Although, put it this way, if anything you read in the news in the next 6 days affects your view of the bull, the bear, or the target, you could definitely use that information. You're just as of today. So the as is of today, but any future, like I said, as new information out, just like the analysts, you're talking about a future. So what they talk about in the conference call tomorrow could influence how you answer your questions. So good point on that one. All right, all the data otherwise there is ready to go. Hopefully you guys have a good sense of what the process assignment is. If you have any questions, send me an email. Otherwise, I'll see everybody 1 week from tonight. Have a good week, everybody.
Professor, sorry to jump in. Was it 500 words per?
No, just total.
Oh, okay.
I don't
Thank
think anybody's gonna have trouble with that word count going across those 4. But the idea is, don't just give me like 3 bullets.
Right.
Like, similar to the EIC assignment you wrote up, give me a write-up for the 4 scenarios.
Okay. Thank you.
Sure.
Thank you.
All right, see everybody next week. Have a good week.
Thank you.
Have a great weekend.
Good night.
Yeah.